Hello traders, you have reached the Phantom, coming to you live from the Phantom's Crypt, where we are haunting the charts and resurrecting profits in a downright ghastly market. Today, September 22nd, 2010, we're simply bringing you this chart to show you why we can't wait to short the Dow in the morning. We're taking a look at the Diamonds Trust Series, which is the ETF that seeks to mimic the Dow Jones Industrial Average. Let's get right into it. As you can see, I've already got a trend line in place. You say, Phantom, how far does that reach back? It's a pretty long-term trend line heading all the way back to July 9th, 2009. That trend line is simply there to make the point that when a long-term trend line breaks or fails, the point at which it fails becomes a key level. And we'll look back here, May 14, 2010, we had a clear break of that trend line. I know you say, well, Phantom, what are you skipping this candle for? You know, that's the flash crash, and everyone's talked about it. Simply, we just have to treat it as an anomaly on the chart. So we're going to use more conventional technical analysis here and just exclude that anomaly. But back on May 14, 2010 is where you had the break. Okay, the high of that day is 107.67. Let's just throw a line here. Since that's going to be a significant level, we'll just send that out here. Now, if you noticed, you'll see that this line has been respected. After a long-term trend line breaks down, the stock may try to retest that level, and if it can't break above it, then we're likely heading to the downside, or at least we should take a little pause before getting long until we break above that. Okay, we think it's actually going to go in the other direction. Let's take another peek at another pattern that's forming on the chart here. As you can see, there's been a little channel action going on in the Dow over the last couple of months, just simply, you know, knocking its head at the top and bouncing off the bottom here, up and down through the channel. And we're up at the top of the channel again. Now, in the past, you know, this level failed and we bounced back down to the bottom. Someone could simply add a short here and say, well, you know, it's happened before. Let me just throw my money in it, see if it's going to happen. We like to have other confirmations before we simply blindly throw our money at a chart pattern. So let's just take a look at the volume. As the price action has headed upward over the last couple of months, this just stands out vibrantly here. There is an obvious divergence in price action and volume. You have to just think about it. If no one's participating in this upward move and volume continues to dwindle, we just can't believe that when volume comes back in, they're going to be happy with buying at the short-term top here. So we think it's most likely that this is going to be pushed back to the downside. But not only is the volume showing us that divergence, we've also got some divergence in the stochastics here. Recently, the Dow's been making higher highs and higher lows. But just take a look at the stochastics over that same time frame. Flatlining, completely flatlining. Without the stochastics making new highs, it's going to be difficult for this to be propelled north on the chart. Okay, now you say, all right, you're going to short it, you're just going to wait for it to go down until it feels right to get out. No, we're going to generate some targets here, let you in on the targets. Okay, obvious first target will be the bottom of this channel. Now, depending on how long it takes the stock to head downward, and depending on the angle of descent, we would expect somewhere around 102. to the downside in the diamonds. A longer term perspective would treat this particular pattern as a bear flag. And if that is the case, just a quick recap, bear flag would be, a move downward, kind of a consolidation move sideways, and then completion would be continuing that downward move in symmetry with this pole of the bear flag. If that were to be the case, usually generate your target by measuring the length of price action here. That gives us, let's see, so we're looking at a high of 112 down here. We've bottomed out at this point at about 98. So you're looking at about $16 of a move from the upside here. And we're looking at 108 minus 16. We got a price target of 96 on this thing. Okay, what you need to understand is the fact that this pattern has taken a while to develop. So we're not expecting it to go to 96 tomorrow, but this is the ideal position to pick up the short, the lowest risk, because here you've got an obvious stop loss at this point. If you get a clear break to the upside above the 108 level, then this pattern has been negated and you just move on to the next trade. Okay, hope this helps, and be careful because it can be scary out there. Thanks.